Hello everyone, this is Mrugesh Patel. I would be presenting on the impact of technology, fintech, and consumer perception in the future of banking. To start with, let's talk about the fintech revolution in banking. When we look banking at a global level, both the physiology and psychology appears to be changing. Smaller and simpler balance sheets, higher buffer of capital and liquidity, customer or client-oriented mission statement, and a lower risk-return trade-off for both shareholders and staff. This depicts the future of banking, and financial markets are pricing banks accordingly. On the other side, fintech, which is shortened from financial technology, is assumed to be a modern movement. Financial technology is used to describe new technology with specialized software and algorithms that seek to improve and automate the delivery and use of financial services. The use of technology to assist financial services is by no means a recent phenomenon. Financial services is an industry that introduced credit cards in the 1950s, internet banking in the 1990s, and contactless payment technology in recent times. Yet, fintech's place in the public conscience has really taken off in the past 3 years. The graph on the right shows the search results for the word fintech on Google. In 2012, the number of searches were close to zero, while it reached its peak in the searches for 2017. This shows the familiarity that this word is getting across the globe. There are some major trends that can be seen in the financial services industry. First of the trend is the shifting consumer behavior. Traditionally, customers have either visited physical branches or phone to conduct banking transactions, and this has been the primary contact points for upselling and bundling cash cow products. A recent PwC survey explains the part of financial sector that are most likely to be disrupted by fintech over the next 5 years, and 80% of the banking experts believe that consumer banking will be disrupted in the coming 3 to 5 years. According to PwC, global banking executives fear that up to 25% of the revenues could be at risk within 3 years due to increased competition from fintech companies. With much larger number of clients accessing banking services through mobile and internet banking and less human interactions through visiting physical branches, customer loyalty to a specific bank has become less perennial. The banks would earn greater customer loyalty by developing simple digital channels that customers embrace. A good example would be Tangerine Bank. The loyalty leader in Canada offers just one type of checking account online compared with 4 to 6 at the major traditional banks. So the locus of loyalty has shifted in the recent year from friendly service at the branch to other attributes, especially simplicity and convenience. The new customer loyalty is with the bank who makes it simple and digital. The second macro trend is depersonalized banking experience. So if we think that the closing of physical branches has gradually depersonalized the banking experience, then it is actually opposite. The graph clearly shows that the correlation between branch scale and deposit growth has weakened for US retail banks. There is 210% increase in deposits since 2008, whereas the number of branches has declined by 15% since 2008. So long ago, banks realized that it would be more convenient for customers if they moved employees out to geographically distributed physical locations rather than forcing customers to travel to a centralized location to do their banking. The main purpose of a bank branch was, and still is, to facilitate interactions between customers and bank employees. Today's technologies, however, enable those interactions to happen without the two parties being in the same location, which is really a customer delight. So if you look at the cost, each mobile interaction incurs a variable cost of about 10 cents, which is a small fraction of $4 cost of a teller or a call center agent. As interactions migrate to mobile, a bank needs fewer tellers and call center agents. This can save up to $11.4 billion for 20 largest US banks. So the closing of physical branches has depersonalized the banking experience, but the same is taken care by newer technologies and customer service has been improved. The third macro trend is emergence of fintechs. Technology has allowed fintech companies in the industry to have more leverage, offering competitive services using much leaner systems instead of heavy, labor-intensive legacy infrastructures that banks have to maintain and support. Technological advancements now allow fintechs to run complex operations virtually. For example, UK-based Revolut has gained 1.5 million customers without any kind of live customer-facing function. The graph shows the percentage of financial services business being lost to fintech companies where fund transfer and payments is highest at 28%. So as a result, 42% of the global banks think of partnerships with fintech companies as per a PwC research report. The fourth macro trend is technological advancements. The drastic improvement in the performance of technologies like mobile banking, highly capable smartphones, 4G mobile connectivity, and social media has combined to force change in the way financial service providers offer their products. Due to mobile banking, routine transactions such as checking a balance or money transfer have been slowly declining at branches. Mobile banking now exceeds online banking among consumers in most countries, with Sweden, South Korea, the Netherlands, and Australia leading the way. The worldwide mobile banking and payments industry is massive, processing transactions over $3 billion a day in 2019. Nowadays, anyone with a smartphone and internet access can become a part of the financial system without the need to open a traditional bank account. In addition to mobile banking, blockchain technology will provide an immutable record of personal data for individuals looking to use mobile payment solutions, giving the industry an added layer of security. The security inherent in these blockchain solutions will prevent fraud. Another development that will support mobile payments adoption is the development and deployment of 5G technology, which reduces latency and transaction times. The fifth macro trend is rapid technology adoption by people. So nowadays, increasing internet penetration, improved computing power, and subsequently better software have paved the way for better and cheaper computers and smartphones. Before 25 years, the internet was still new and some even referred to it as a fad. In reality, they could not have been more wrong. If we look at the figures of 2018 in the graph, staggering 81% of the developed world was connected to the internet. Looking at the second graph, it is clearly evident that back in 2006, almost no one used their phone to access the internet. By 2017, only a decade later, more than 50% of the global web pages were browsed using smartphones and tablets. The sixth macro trend is tech companies are ahead of the curve. The new-age tech companies like Amazon, Facebook, Google, Apple, and Uber have mastered the art of agile product development, resulting in enriched digital experiences that are so attractive that people become addicted to them. The graph to the right illustrates the massive growth of Facebook over the previous years. Nowadays, companies like Facebook are considering providing financial services with this huge customer base. Even companies like Apple offer leasing of its iPhones, and WeChat offers instant lending in China. These tech companies are convinced that they can bring superior banking services to their customers. The seventh macro trend is PSD2 and fintech app development. The prediction is that 75% of the large banks will be actively engaged in supporting fintech app development through open banking. This will be driven by Services Directive 2.0. PSD2 is an EU directive designed to provide a level playing field to third-party providers such as fintechs by giving them the permission to retrieve customer bank transaction data via APIs upon request. With PSD2, major European banks have lost their monopoly of huge customer database, which constituted a major competitive advantage. Hence, many investor-backed fintechs have set off to build niche bank products on top of existing customer data. During 2019, fintechs raised a record $33.9 billion from investors globally. The eighth macro trend is regulatory technology. RegTech investment in the financial services sector have increased substantially from $10.6 billion in 2017 to more than $53 billion. They address regulatory reporting, compliance checks, risk management, identity management, and transaction monitoring. Currently, 15% of the financial institution employees work in compliance. Multiple large financial institutions are utilizing RegTech solutions and seeing efficiency improvement and significant ROI from these solutions. Rabobank, a large bank headquartered in Netherlands, had its compliance team implement a risk management solution that reduced 15 minutes compliance checks to 3 minutes. The ninth macro trend is challenging time for banks. Currently, banks face the risk of customer service unbundling. For every service that bank customers stop using, banks lose an important contact point for relationship building and upselling. Eventually, banks may end up in a situation where they can't compete with any digital product, thus leading to pressured margins, loss of market share, and customer churn, as shown in the graph. And lastly, in order to maintain customer stickiness, consumer banks need to make the digital consumer experience a top business priority. Developing great digital products will require banks to observe customer behavior and fulfill their needs in a beautiful, engaging, and relevant way by using agile and data driven methodologies. Thank you.